Okay, so if you want to learn how to trade options, then you're going to have to learn the option chain. Now, there's a lot of pieces of the puzzle that have to be put together in order for you to understand how to trade options effectively, because the last thing that you want is to go in and try to make some sort of trade and not fully understand everything that's going on, okay? So in this video, we're going to go through step by step through each piece of the option chain so that we can build that confidence when buying options, selling options, making covered calls and all that fancy stuff. So if you're ready, then so am I. Let's get going and jump into the option chain. All right, let's start by pulling up the option chain on either a stock or an ETF. In this case, I'm going to go with SPY, which is the ETF that tracks the S&P 500. And you're going to go to it, open it on your favorite trading app. I am using Public today. So I'm going to go trade and trade options. And this is what's going to pop up. This is the option chain. Now, at first glance, it might seem very confusing, but don't worry. Like I said, we're breaking everything down step by step so you understand it. So then when you go into the option chain, you're going to know exactly what is going on. All right. So I'm going to scroll down. I'm going to scroll up. I see all these numbers. I'm really confused. I have expiration dates up here. I have buy, sell, calls, puts. Don't worry. By the end of this video, you're going to understand all of this and more. All right. Now, really quickly, if I go ahead and open one of the options, you're going to see a whole bunch of other info. Now, this is also important to understand to make the best decision possible when buying options, selling options, all that kind of stuff. So by looking at all of this, you might not initially understand what everything means, right? Like, what is the difference between volume and interest? Delta, is that important? Theta. So before clicking that buy to open button there at the bottom, let's go through everything step by step. All right, the first thing that I want you to understand is that there are 4 types of option trades that you can make. All right, so you could either buy a call or you can buy a put. You can sell a call or you can sell a put. Now, this is on the buy side. So by buying options, there's 2 things that you can buy. You could buy a call or a put. And on the sell side, you can either sell the call or sell the put. And these are the 4 types of trades that you can make when trading options. Now, there are combinations of all of these spreads and weird iron condors and all of those more advanced techniques. But at the basic level, everything is constructed by one of these 4 trades. Now, if we jump into the option chain, you can see exactly what we're talking about here, right? At the top, you see buy and sell, and you see calls and puts. And there's 4 combinations that you can make of all of these, right? You can buy a call, which is what it's set on right now. But let's say I want to sell a call, I'm going to switch to sell. So now I'm selling a call. If I want to sell a put, I can switch this side to from call sides to the put sides, right? If I want to buy a put, then, well, let me switch that back to buy. So now I'm buying a put. And each of these trades do different things, right? So let's put up a definition of each so you can understand them and move forward from there. All right, buying a call. This gives the buyer the right, but not the obligation, to buy stock at a given strike price on or before the expiration date. You pay a premium to buy this contract. Now, for buying a put gives the buyer the right, but not the obligation, to sell stock at a given strike price on or before the expiration date. Again, you pay a premium to buy this put contract. Now, for selling a call gives the seller the obligation to sell shares at a given strike price on or before the expiration date. When you sell a call, you collect a premium for doing so. To do this, you would need to own at least 100 shares of the underlying stock as collateral. Now, for selling a put gives the seller the obligation to buy shares at a given strike price on or before the expiration date. When you sell a put contract, you are receiving a premium to do so. You will need cash in your account in order to buy 100 shares of the underlying stock for every 1 option contract sold. So to take a look at the key differences there, when you're buying a contract, you're paying out a premium and you're getting the right, but not the obligation to use that contract to either buy or sell shares, right? So if you're buying a call, you have the right to buy shares at the strike price on or before the expiration date. When you buy a put, you are getting the right, but you don't have to use this right to sell shares at a given price, which is the strike price on or before the expiration date. Now, when you sell options, this is where the obligation comes in. This is where you have to take on the responsibility and the risk in selling that call option. And what is that responsibility? Well, when you sell a call, you are obligated, if the stock hits the strike price, to sell your shares at that given price on or before the expiration date. And when you sell a put, again, that obligation is on you to buy shares at a given strike price on or before the expiration date. So lock in those definitions because that's important. So you'll notice that I mentioned a few things: strike price and expiration date, right? So the strike price is just the specific price that is locked into the contract. That is the agreed upon price between the buyer and the seller. So when you go into the option chain, you're going to see a bunch of strike prices, and that is the agreed upon price between the buyer and the seller of that contract, right? So let's take a look over here. So the strike price, let's say the stock is trading at $100. Well, you can pick a strike price that is below that amount, at that amount, or higher than that amount. All right. So I'll give you an example over here. Stock is trading at $100. You can go ahead and you can buy a $95 strike price, for example, if you're buying option contracts, which is going to be below that price. And we're going to talk about exactly the definition of all of that in a second. Or you can buy with the strike price at the exact price of what the stock is trading at. So if the stock is at 100, you could buy a strike price at $100. The third option is buying a strike price at a higher amount than the stock is trading at. So if the stock is trading at 100, you could go ahead and choose a strike price that is above that $100 mark, 105. And the same thing happens when you sell options as well. But there is an asterisk to that. So when you sell an option, let's say you sell a call option, you want to sell a call option for higher than the amount that the stock is trading at. Because selling a call option forces you to sell shares at the given price, right? So why would you want to choose a strike price that is below? Then you would be forced to sell below the actual stock price, right? And that doesn't make too much sense a lot of the time. Now, when selling puts, you're going to want to choose a strike price that is below the current stock price, because again, you are then going to be obligated to buy shares, right, through your option contract, put option contract. I'm selling puts, I'm obligated to buy shares. So it's very unlikely that you're going to want to sell a put that is higher than the strike price, because then what you are saying is, I'm okay paying more for these shares than they're actually worth right now. And a lot of the times that doesn't make much sense either. Now, when you actually go into your investing app to look at this, you want to make sure that you are using a platform that makes investing super easy to understand. Now, like I mentioned, I am using Public in today's video. Public is the investing platform for people who actually want to understand and grow their portfolio. Now, when it comes to options, Public is one of the most cost-effective platforms out there. You'll earn a rebate of 6 cents to 18 cents per stock and ETF contract, which helps minimize your options trading costs. But Public is not just for options. You can trade stocks, bonds, crypto, and more all in one place. Now, some of the features I really love is Public actually gives you a 3.8% APY on your cash with no minimums or subscriptions. So you can earn money on your cash that's just sitting in your account. I also love how AI is built right into the experience. You can get AI-powered earnings calls, recaps, and AI portfolio insights. Now, this is a feature that can really help make smarter decisions with your investing. But here's probably my favorite feature. Public gives you an uncapped 1% match when you transfer your portfolio. That is just money added straight into your account. Now, it takes less than 5 minutes to open up an account. Just go to public.com/Pandrea, or you can click on the link below. Full disclosures are down below in the description. That's public.com/Pandrea. Now, let's get back into the video and further understand the option chain using Public. All right, now for the expiration date. Now, an expiration date is when the contract expires, right? And you have options, no pun intended, of when that contract will expire. So you can choose your own expiration date, right? So you can choose an expiration date that's very close to today's date, a little bit further out, or way further out, like years out. So for most stocks, they have an expiration date on a weekly basis, right? So every week, there's an option contract that you can buy with that expiration date. Now, on certain indexes like SPY, you have daily expiration dates, right? So they expire every day. So you can buy a contract expiring the next day or today if you want. But what is the difference? Well, the closer you are with your expiration date to today's date, the riskier that's going to be for you. And the simple reason for this is that we cannot predict what happens in the short term, right? So it's just a guessing game at that point. This is where a lot of the risk and the sort of gambling aspect of option trading comes from. You are making a bet that something is going to happen with the stock in 1 week's time or 2 days' time or something like that. And that's very unrealistic to try to predict. So 1 week out, as an example, is very risky because you're not letting your investment play out, all right? Now, the further that we go out in expiration, the more chance you have of success in that option trade. As in, whatever your goal is, it's more likely to happen if the expiration date is set further away. So let's take a look at 3 months, right? 3 months has, I would say, moderate risk, right? Because you're stretching out that expiration to 3 months, 6 months, whatever the case may be. But if we're talking months now you have a better chance for that stock to move in the direction that you want and therefore make money off of that trade, right? Now let's take a look at 1 to 2 years. Now, 1 to 2 year out contracts are known as leaps, and these are sort of the safest, if you want to put that term in quotation marks, as safe as options can get. These are the safest types of options that have the less risk possible for you to lose money. Now, of course, you can still lose money on all option trades, but if we are comparing expiration dates that are further out versus ones that expire next week, obviously the less risky option is to go out further in time as much as possible to let your trade play out. All right, so jumping into the option chain to understand the strike price and the expiration date. So you can see at the top that you have the expiration dates. Now, you can see June 25th, June 26th, June 27th. These are all daily expirations of the contracts because we are on the SPY ETF. Now, if I were to switch that out and let's go to, let's say, Apple stock, for example, then you can see that Apple stock has an expiration date of June 27th, and then the next one is July 3rd, July 11th. So these are weekly contracts, right? And you can go out all the way out to, let's see what the last date is, December 17th, 2027. So all the way out, right? So again, scrolling back, and if we're going for like this week or next week, June 27th or July 3rd, it's more risky, right? Because there's less time. But if we go all the way back out to December 17th, well, I think we have more of a chance of success because there's more time for that trade to occur exactly how we want it to occur. Now, going back, I want to go back to the SPY and go to trade options so you can see the strike prices, all right? Now, the first thing that you should look at when opening up the option chain is right in the middle here, this green line. It shows the current price of the stock or the asset that you're trading, right? So the current price right now is 606.78, so $606.78. And now on the left-hand side, you're going to see all of these numbers. These are the strike prices. Now, like I mentioned, you can pick a strike price that is below the current stock price, above the current stock price, or right about at the current stock price, right? So if I take a look at the first strike price that is above and the first strike price that is below, that is going to be the at the money call option, okay? The strike price for at the money. So now if I start scrolling up, you'll notice that the strike prices are increasing in value above the current stock price, right? So if it's 606 currently, then above it will be 607, 608, 609, 610. These are increments of $1, and these are strike prices that are above the current stock price. Now, if we scroll down, you'll see that the strike prices are descending, right? So current stock price is 606.78, and then the first one below 606, so that's sort of at the money. But if I keep going down, 605, 604, 603, these are all strike prices that are below the current stock price. So these are two very important characteristics of an option contract. You have the strike price, you have the expiration date, and you also have the premium. So the premium price is basically the price of the option contract. Now let's look at the characteristics of a premium. So one contract is worth 100 shares of the company. Now what does this mean? Well, if I buy one option contract, I get to control 100 shares of the company. So let's say you have an option contract that is trading now for $2, right? Well, that $2 is not in fact $2. It's $2 times 100 because again, you are trying to control 100 shares with that one option contract, right? So all the option contracts written in that contract, I have the right but not the obligation to buy shares. Well, how many shares am I going to have the right to buy? Well, the answer is for every one option contract, it's 100 shares of the company. And same thing when you sell. So when you sell a call option, for example, you are agreeing to sell 100 shares of that company. Now, because you have two parties in this transaction, the premium is going to mean something different whether you are a buyer or a seller. So the premium is paid by the buyer and it's collected by the seller. Now, this makes sense, right? If I'm buying something, I pay to buy it, right? So I'm paying the premium out, so it's debiting my account. And when I'm selling an option contract, I am collecting that premium. So the premium is going from the buyer to the seller. The buyer pays the seller and the seller collects from the buyer. That should be pretty straightforward, but I did want to go over that because that could be sometimes confusing. Like, where am I getting this payment from? Well, there's two sides of the option trade, the buyer and the seller. and the transaction between premium goes from one to the other. Now, typically, you're going to have different prices for out of the money options and in the money options. Now, we're going to get to what exactly out of the money and in the money means. But if we refer back to the strike price, you can see that strike prices can be below the price of the stock, at the price of the stock, or they could be above the strike price, right? So out of the money options tend to be less expensive, all right? So they're cheap. They're cheap to buy, but they're also cheap to sell. So if you're trying to sell options, you might not get a lot of premium if they're really far out of the money. And within the money options, they tend to be more expensive, right? So if you're buying in the money options rather than out of the money options, you might be paying more for that premium. Now let's take a look back at the option chain so you could understand what's going on here. So let's say I want to choose the $608 call option, right? I'm going to click it. I'm going to go ahead and click it and then say buy to open here at the bottom, all right? Now here's what I was talking about, that one contract controls 100 shares. So if I click one, you can see that the price per contract is 99 cents. But you can see the estimated order amount is $99. Again, you're taking the 99 cents, you're multiplying it by 100, and this is the amount that you're going to pay. In this case, that we're going to buy an option contract, so we're buying a call option. We are going to pay $99 for this option contract, and then we get to control 100 shares of the company. So I'm paying when I buy an option contract, but that is the same amount that I'm going to collect when I sell an option contract, okay? So now taking a look at out of the money and in the money options to see how that premium changes, I'm just going to scroll down. So you can see $2.08 for the sort of at the money call option. And if I scroll down, you can see that that premium on the right-hand side increases in price, right? So $2.79, $3.57, $4.41, and it gets more and more expensive the more in the money that you go. Now, on the other hand, if I scroll up, you can see that the prices of the premium become cheaper, right? So 146, 99, 62, 38, 22, 13, so on and so forth. So this concept is very important to understand, especially moving forward with everything, right? The premium price per contract is going to differ whether it's in the money, out of the money, at the money, and the further out it goes or the further in it goes, then it is going to change accordingly. Okay, now let's break down in the money and out of the money. Now, this could get a little bit confusing, so stay with me over here. Now, looking at the chart of the stock is going up and up and up and up, and this is what we want with a call option, all right? So this is, let's say we're buying calls at this point, right? The strike price that we're going to choose is $100, okay? So now let's start with the graph here around $80. Now, the stock is trading for $80 at this point. That means that the stock is below the strike price because $80 is below $100, obviously. This is considered out of the money because the stock has not reached the strike price yet of $100, right? So now the stock goes up and up and up and it hits $90. Well, $90 is still below the strike price of $100. So this is considered still out of the money. And the stock keeps going up and up and up and up, and it hits $95. Now, at $95, that stock is still out of the money because it hasn't reached $100 yet. All right, keep going up and up and up and up, and now it hits the strike price. So now the stock has trended up and it hit the strike price of $100. Now, what is it called? It's called at the money. So your option is at the money at this point. This is trending in the right direction. Now, let's see what happens if the stock keeps going up. So if it goes up from 100, from at the money, and it goes up and up and up and up and it hits $110, right? So now $110 is above your strike price. So the price of the stock is above your strike price. This is called in the money. And it continues to go up and up and up. And now look, it hits $120. Well, if your stock is trading at $120 and your strike price is back down at 100, that essentially means that you have the right to buy shares of this company at $100 and effectively turn around and sell it for $120. So you're going to make a profit in between. So in this case, all of these from $100 all the way upwards is in the money options. And this is what you want when buying call options, because when you buy a call option, you want that contract to have value. And it has value essentially if you are able to buy at a lower price and sell at a higher price. Now, back down here with out of the money options, you weren't able to do that, right? Because if you were to have a strike price of 100, right, and the stock is is trading at $80, well, that option has no value. I'm sorry to tell you that, because essentially what that's saying is that you have a right to buy stock at the strike price at $100, but you wouldn't do that, right? Because if you bought it at 100 and you sold it at 80, then, well, you're losing money on that whole transaction. So if this is the scenario at the expiration date, your contract is worth $0. It's worthless because nobody would pay for your contract only to have the right to buy stock at a higher price and sell it at a lower price. Now, if you take a look at, let's say, the $609 call option, that is above the current stock price, right? Because the current stock price is $606. So it's called out of the money because the stock has not reached that strike price yet. This is for buying calls, right? So when the stock is still below that strike price and it hasn't reached there yet, it's out of the money. Now, an in the money strike price would be everything that is below the current stock price, right? So for example, the $604 call, that would be considered in the money because the stock price has already gone up, reached the strike price, and then surpassed it to reach 606. You had the strike price at 604, it reached that price, it went above it to 606, and now that stock price is above the strike price. So that strike price, that contract with that strike price is in the money. So I hope that makes sense. So again, just to go over really quickly, when you have a stock price of less than the current strike price, your position is out of the money. And when you have a stock that is trading higher than the strike price, then you have reached your goal of that stock hitting your strike price and exceeding it. Then your option is in the money and has value. All right, now let's break down the bid-ask spread, because when opening up a contract, you're going to be faced with two numbers, the bid price and the ask price. And you might be looking at that and not fully understanding where that comes into play. So when you are buying an option, you are bidding for that option. Okay. And when you are selling an option, you are asking somebody to buy that option, right? So that's the sort of easy way that I think of it. So when you bid for something, I like to think of it like you're bidding on eBay for an item, right? You're putting in how much you're willing to pay for that item. I am putting in the highest price that I am willing to pay for this current option. Now, on the ask side, this is what the seller is asking as a price, and this is the lowest price that they are willing to accept to sell that option contract. So as you can see here in this example, we have a difference between the bid and the ask. This is called the spread, the bid-ask spread. Now you have a bid of $2.08 for the contract and you have an ask of $2.17. Well, these bid and ask prices are fluctuating all the time. So when you want to buy an option contract, for example, you're going to take a look at the mark price, which will be between the bid and the ask price. So as you can see here, the mark is $2.12 because something's got to give between these two numbers, right? They want to buy it for this amount, they want to sell it for this amount, and ultimately it will come down to somewhere in between where you actually buy that contract. All right, let's go ahead and open up an option and take a look at the bid and ask spread, right? So in this case, you have the Apple $205 calls, and you have a bid of 38 cents and an ask of 40 cents. Now, this is a very close bid-ask spread. You only have 2 cents in between. Now, this is usually what you're looking for. You want a very tight spread because then you're not losing money on one end or the other, right? We have a 38-cent bid and a 40-cent ask, and you can see here the mark is 39 cents right smack down in the middle. And this is because Apple, in this case, is high volume, high liquidity stock that is traded in high numbers during the day. So when you buy this option, you're not going to lose too much on the bid-ask spread. Okay. All right, next, this is something that I used to get confused about all the time, the difference between the volume and the interest, okay? Now, for volume, this means that these are the amount of contracts that have been traded today. So it's on a daily basis, and the volume updates daily, right? So tomorrow there'll be different volume than there was yesterday than there will be tomorrow. So if you see a volume of 464, that means that 464 contracts have been traded today thus far. Now, this is different from the interest or open interest, right? You sometimes might see that referred to as open interest. This is the total number of active option contracts for a specific strike price and expiration date that have not been closed, exercised, or expired yet, right? So if I buy an option contract, it is open, right? So that will go into the open interest. It will also go into the volume, right? Because I opened it today, I made that trade today. But let's say tomorrow goes by, I'm still holding that contract. Well, then it is still part of the open interest until I close it, right? But it's not part of the volume because, well, that day has passed already. So both the volume and open interest show market activity and liquidity, basically, right? So the more people that are trading that option, the higher these numbers are going to be. So let's take a look at the $205 Apple call. And if we click it open, you're going to see volume and interest. Now, as you can see by the numbers, volume 77,000. That means today 77,000 contracts have been traded and open interest of 47,000 that are open. and ready to be closed or close to expiration or whatever the case may be, okay? So obviously the options for that market are very liquid. There's a lot of volume, a lot of liquidity, a lot of open interest for that. But sometimes you might look at a contract, pick a strike price and expiration date, and you see there's really no open interest to that, right? There's no volume, there's nothing's happening with that. So in that case, it would be harder to either make a trade, or if you buy something, right, maybe sell it, you want to sell it with high liquidity, it might be harder for you to do so. So that is something to keep in mind and always look at when trading options. All right, now I want to take a look at the break even and the profit price, because this is something that is very important to understand before placing the trade. What is your break even price, and when do I start making money and when do I lose money? You want to know your profit and loss of that particular trade, but also you want to know your break even price, because that's very important and a lot of people overlook this. So let's go back to this example, and let's say you're paying $2.12 per contract, and let's say that the stock is trading at $100. Okay, so we've created this scenario, and here is your break even price for this transaction. All right, so this premium price effectively is saying that you are paying $2.12 times 100, so you are laying out $212 to buy this option contract. Well, here's what happens. Let's say that this price right here is $100. Okay, so $100 over here, and let's say this goes down in value, the stock price goes down this way, all right? And on the other hand here, let's say $120, all right? So the strike price is going to be about here. Now the stock is trading, and it could trade from $80, $100, $120. You want to see while the stock moves if you're going to lose money or make money. So you bought this option contract and you are down $212 so far, right? Because you had to pay $2.12 to buy this option contract. So you are already down $212. Now, to make money, you have to hit the break even price. Now, what is the break even price? The break even price is the strike price plus the premium. All right, so let's do that math. The strike price is $100 plus the premium you paid is $2.12, right? So you have to have this stock go to at least 100 plus $2.12. That's $102.12. So the break even price over here is going to be $102.12. This is where you start making money. All right. If it goes past that amount, you're going to start getting profit. Now, what happens if it just stays right at that break even price? Well, then you're breaking even on the investment, right? Because essentially what that means is that you can buy stock for $102.12, but then you have to sell it at the open market at $100. Well, you would think you would make a profit there, right, of $212, but oh, wait a second, I had to pay $212 to enter this contract. So basically, you're just broken even right there. All right. Now, if the stock stays at the strike price of $100, you are actually breaking even on the exercise right of your shares, but you're still losing money, that $212, because that's what you had to pay. So even though you can buy the shares at 100, sell it at 100, you make $0 on that, you still paid the premium of $212. So that means that at the strike price, you're still losing that $212. And that is the case if the stock continues to go down. So if the stock goes down to $95, $90, $85, $80, you are still going to lose this premium paid, okay? So it doesn't matter how far down that this goes, you could only lose the premium that you paid. Now you start making money, of course, if the stock keeps going up. So if it goes to 105, 110, 120, this is all profit right here. So pulling up the option chain over here, I want to show you how this looks. So we're going to go trade and trade options. Let's go out a little bit out in time. And let's take a look at the $210 call option. Now, for me to buy this contract, it's going to cost $8.90 or $890, right? That's the premium price. So let's click it open. And now let's look at the break-even price for this trade, all right? So max loss is $890. Again, because I'm paying $890 per contract times 100, that is the max loss that I can incur on this trade, right? So even if the stock goes down all the way to zero, I'm only losing the premium. My losses are capped, all right? So you can see here, if I scroll all the way down, even if the price goes down to 183 or 192, anything that's below the current strike price, I'm going to lose that $890, all right? Now, as I continue to come up, I am losing less and less money until I get to the break-even price of $218.90. Now, again, that math is as follows: $210 strike price plus the premium paid of $8.90 makes $218.90. And that is your break-even price. And now I'm going to scroll further and further up, and you can see that the profit increases as the price of Apple shoots up more and more, okay? So at $240, I'll be making over $2,000, right? So your profits could go up infinitely, but your max loss is capped at the premium paid. All right, moving on to Delta. Now, Delta is part of the Greeks, and I think it is one of the two that you should look at and really understand as part of the option chain. So you know how it affects not only your premium price, the price that you paid or sold the contract for, but also your percentage chance of profit. All right, so what is Delta? Well, Delta is going to tell you how much your option contract will increase or decrease with every $1 stock movement. Now, Delta is a range between -1 and 1, all right, with 0 in the middle. Now, call options will have a delta of between 0 and 1. And put options will have a delta between 0 and -1. Now, it will never hit these actual marks. So it won't hit 0 or 1 in the call option side unless it gets to expiration. So at expiration, a call option, for example, could either be a 0 or a 1. And that's going to depend on whether it finishes in the money or out of the money, okay? So by looking at the delta, we can then determine how much our contract is going to be worth for every $1 stock move. So here's an example. If the stock is trading at $100, and let's say we have a delta of 0.3, okay? So 0.33, which is about right here between the 0 and the 1 for call options. Then, so a delta of 0.33, then for every $1 stock movement, our delta will increase by 33 cents. All right, so you take the delta and you add it to the premium, the cost of the contract, and that is going to tell you what the new price of the contract will be worth if the stock moves from 101 to 101 or 101 to 102. So for every dollar this moves, then the price of the contract will move by the delta amount. So a $2.12 delta will now be worth $2.45 if the stock moves by $1 upwards. Now, if the stock moves down from 100 to 99, then again, the price of the contract will decrease by the delta amount. Now, you could also use delta to understand your estimated chance of your contract expiring in the money. Because when we, let's say, buy a call option, this is what we want. We want our contract to expire in the money for it to have value. So a delta of 0.33 can translate to, again, an estimate around a 33% chance that this option will expire in the money. And you might look at that and say, well, only a 33% chance. Maybe I don't want to buy this option because the odds are not in my favor, right? So you might look at an option that has maybe a 0.7 delta, which takes your odds to a 70% chance of expiring in the money. Now, when selling calls, you want to take the opposite approach, right? So if I'm buying calls and I have a delta of 0.33, that means I have only 33% chance of success on this trade. Well, who is taking on the other side of the trade? It's the seller. So when you sell an option contract of 0.33, that means that you have a 33% chance that that contract will expire in the money. Well, this is a good number to have on your side because when selling option contracts, you want that contract to expire out of the money. So you want to put the odds in your favor for that particular trade. Now, when looking at strike prices that are out of the money, if I go up to the $210 call over here, you can see that the delta is 0.27, so close to 30, right? So this translates to about a 27% chance that this particular contract, the $210 call option expiring July 18th, is going to expire in the money. Only 27% chance, so not likely. Now, if I go to another option that is more in the money, let's go to the $190 call, you can see that now it has a delta of 0.8280. And again, this translates to about an 82% chance estimate that this contract will stay in the money. Because it is in the money already, there's good chances that it will stay in the money because, again, stocks trend up, and so you're more likely that if you have an in the money option, it will stay in the money unless something drastic happens. But 8 out of 10 times, this is going to end in the money and your contract will have value. Now, another key piece is Theta. Just like Delta, it's part of the Greeks. And I think, in my opinion, Delta and Theta are the most important ones. Now, what is Theta? Well, option contracts naturally lose value from the date that they are open until expiration date. Now, the closer your expiration date is to the current date, the more Theta is going to eat away at your contract. So the more value you're going to lose each day to Theta, this thing called Theta. Now, if you have a longer expiration date, that Theta is sort of spread out between a longer time period. So your contract loses less value each day because you have a longer expiration date, right? So let's take a look at an example. Let's say you have a Theta of negative 0.25, all right? And you have a stock price of $2.12. Well, if nothing happens with the stock, right, it doesn't go up or down, so the contract doesn't change, right? Again, if it goes up or down, then your contract is going to increase in value or decrease in value. But if nothing changes from one day to the other, then that $2.12 contract will then lose 25 cents for every day. So now it's going to be worth $1.87 because Theta ate away 25 cents of your contract. Now let's take a look at the next day. So your contract is now worth $1.87. And let's say that stock still doesn't move. Well, a day went by and Theta does its thing and it eats another 25 cents off your contract. So now you're going to be left with a contract that is worth $1.62. And nothing happened with the stock. It didn't go up, it didn't go down, it stayed the same. But because time is moving by as it does, we can't stop it. Theta will eat away at that contract. Your contract will lose value. So this is why it's very important, especially when buying call options, for example, you want that stock to move quickly, right? The shorter the expiration date, the quicker you want it to move to make up for this loss of Theta. So let's take a look at an example. We have the $205 call, which is an out of the money call option. I'm going to take a look and you're going to see that the Theta right here is negative 0.2137. So 21 cents effectively your contract will lose. Well, how much does the contract cost? Well, if we go back, you can see that the contract cost 40 cents, right? So 40 cents minus 17 cents, that's a lot of loss in one day for your contract. And that is because we have an expiration date of pretty close to the current date. But if we go out further, let's say we go out all the way to December, right? That same contract, the $205 call option, that is going to lose only 5 cents, right? You have a Theta of negative 0.0535, and that means that for every day, only 5 cents is coming off your contract, and 5 cents off the contract of $15.15. So you can see the difference of having a short-term expiration date and a long-term expiration date because we always want to fight Theta, right? Especially when buying call options, we are constantly fighting that Theta decay. So understanding the Theta is very important because you don't want to buy a call option that has a very high Theta and you end up losing all that money. And you look at that contract, you're like, well, the stock didn't move. Why am I losing all this value in my contract? And it's because of Theta. So that's important. Now, another key piece that is very important in the option chain is the implied volatility or IV percentage. So let's break this down. You're going to open up the option chain and you're going to see an IV percentage. This stands for implied volatility. Now, the implied volatility is not on the option contract itself. It is actually the implied volatility of the underlying asset or stock that option contract is for. Now, this is a very important distinction because understanding the implied volatility on a stock is different than the implied volatility if it were to be on the option contract itself, all right? So first, let's understand what implied volatility means. Well, when you see a percentage, that means that stock is going to trade within the range of that implied volatility amount, all right? So let me explain what that means. Let's say that you see an IV percentage of 20% and the underlying stock is trading for $100. So this basically means that this $100 stock can trade within the range of 20% either up or down, all right? So it can trade up to 120 or it can trade up to 80. Now, this is the expected range based off of the volatility, and the volatility is based off of the supply and demand of options. So it's not a historical number, right? Looking at the past to try to predict the future. No, it's based off of how many option contracts are bought and sold, and that creates the implied volatility of how much the market expects this stock to move. So a 20% IV means that this stock is expected to move somewhere between 120 and $80. So if it moves down 20%, it'll be at $80. If it moves up 20%, it'll be at $120. Now here is where it gets a little bit tricky. So we need a time frame for this, right? So IV shows the time frame for 1 year. So knowing that, let's apply it to the $100 stock. Well, within a 1 year time frame, that stock could trade in between the range of $80 and $120 with the IV of 20%, up or down 20%. And it is based off of a standard deviation. Now, without going into too much detail on that, just know that one standard deviation is about 68% of the time. So 68% of the time, this stock, the $100 stock, will trade between $80 and $120 based off of the implied volatility of 20%, okay? So you don't have to really understand that math of 68%. Just know that it's more likely than not that it will stay in between this range based off of the implied volatility, all right? Now, here's where it gets a little bit interesting. Let's say you have a stock at $100 and you have an IV of 100%, because sometimes you see 100%, sometimes you see even more, right? So what happens if it has a 100% IV? Well, then that $100 stock price can trade in the range of, well, here this should be $200, right? So $200, 100% up in that direction, and believe it or not, down to zero. Now, this doesn't necessarily mean, of course, that the company will go bankrupt and that $100 stock will trade down to zero. That's just the range that where the stock can trade in between. Because the implied volatility is so high, it can have huge ups and down swings. So this is just a reference point of 100% IV that it can go trade somewhere in between that range, and it won't do it all the time. Only about 68% of the time will it move in this range, but it is not limited to these ranges, right? So that is what IV stands for. Now let's take a look at the implied volatility of Apple, for example. So we're in the option chain, and let's click on the $205 call, and you can see that there's a 26.79% IV. So implied volatility is 26% around there, right? 26.79. Now here's the interesting thing. Let's go to another option, and you can see 26.79. That is because it is not based off of the option price itself. It is based off of the underlying stock, which is Apple, and Apple has an IV currently of 26.79. So that means that this current price of $200, if we do the math, so let's go 200 plus 26.79%, that will give us a range, a top range of $253.58, and a bottom range of, what was it, 26.79% of $146. Okay, so the IV is telling us that Apple would be expected to trade between this range based off of the supply and demand of the options themselves. Okay, so now we hopefully understand when we open up the option chain what everything is, and you're ready to go buy or sell options. But there's one more step that we have to go over, and that is the type of order that you want to place, because there's 4 types of orders. So let's go over them right now. Now, first, you have a market order. This is pretty much the most common type of order that you might want to do, and that is going to buy the option contract at the current price. This is also the fastest way to do it. So if you're not really concerned about the price itself to get a specific price, and you just want to buy or sell that contract, well, then you're going to go market order, and it's going to buy that contract at around whatever that bid-ask spread is. Now, say that you want to be a little bit more specific and you want a certain price, so you don't want to pay more than a certain price for a contract, or you don't want to sell less than a certain amount, then you're going to use a limit price. So the limit price will execute your order at the limit price or lower. So say that you want to buy a contract, all right? And you don't want to pay more than a certain amount, right? Because in your eyes, maybe it doesn't make sense. So you're going to put in a limit order, which is going to buy your contracts at a specific price or lower. If you could get a cheaper price on the market, then it's going to activate that cheaper price. But you want to set a cap, a limit to how much you're going to pay for those options, for example. Now, here's where it gets a little bit more tricky with the stop order and the stop limit order. So let's go over them. You have the stop order and the stop limit order, all right? So the stop order triggers market order when option hits price. So what does that mean? So let's say you bought an option contract and it is currently trading at $3. You can then set a stop order for, let's say, $2.50, just as an example, to stop your losses, right? So if that option contract goes from $3 down to $2.75 to $2.50, then only at $2.50 will you sell that option contract. And it will do so at the next available market price. So it's going to trigger a market order for that stop price. Now, a stop limit order will trigger a limit order when the price hits. Now, this adds a little bit more control to you than a stop order does. Now, a stop limit is broken up into 2 prices. You have your stop price and your limit price. So again, let's say you have an option and it is trading at $3. You own that option. You can then put on a stop limit order with the stop price being, let's say, $2.50 and the limit order being $2.40. Now, if the price drops to $2.50 from the $3 it was trading at, it will then trigger a limit order to sell, but only at $2.40 or better. So $2.40 is the cap. I don't want to sell under $2.40, and I will start this process at the $2.50 stop order. And this is good in fast trading markets where the option contract shoots up, shoots down very, very quickly. You might want to protect yourself by using the stop limit order. Now, jumping into the option chain, I want to show you the different types of orders. So let's just click a random contract. Let's go buy to open here at the bottom. And you're going to see in the top left corner, you have your options, right? So you have market order, which is buy at the current market price. This is the quickest way to buy. A limit order, which is going to be buy at the limit price or lower. So it's going to try to get the best price possible at that specific price, but it won't go higher than that price. So you're capping it with a limit. A stop order, which is buy at the market price if the price drops to the stop price. So again, you own a contract and you want to stop your losses. So you put in a stop order for that certain amount that is below your current option price, and your stop limit order, which is buy at the limit price or lower if the price drops to the stop price. So it has to drop to the stop price, then a limit order is triggered, and then it will sell at the limit order that is below the stop price, okay? Now for me, I tend to mostly use just market orders, right? Because a few cents here and there, it's not going to do anything for me because I'm not trading in and out. I'm not a day trader. I don't try to profit off of a very small amount. So for me, it doesn't really matter. But for different situations, you might want to look at them. So it is important to know what they do and how to use them. Now, putting all of this together, I hope now you have a better understanding of not only the option chain, but your particular trade and what you should look for when entering that position. Because, well, the more we know, I think the better success we are going to have in our investing. And that hopefully leads to more profit for you. Now, if you like this kind of content, you know what to do. Check out my other videos on investing in options. Check out the link down below if you like options and want to learn more. I thank you all so much for watching, and we will see you on the next video.